So we're here with Professor Damodaran, Professor of Finance at NYU Stern. When Facebook went public, I remember you saying you thought it was overvalued. It went down to 18, then you said it was undervalued, and it skyrocketed up to 60 or 70. So you made a pretty good call there. I'm just going to throw out some names, and you tell me what you think of their current valuations. Apple.
I just sold Apple at 130. So I bought it at 60 and I sold it at 130. So I liked it at 60. At 130, I think it's fully priced. I don't think it's overpriced. So if you want to add Apple to your portfolio, just don't expect it to double over the next year.
So a quick diversion. I've always heard, or there's a train of thought that you buy stocks and never sell them because of the taxes you have to pay, diminished returns. You trade stocks.
I sell because I have to follow the same philosophy that led me to buy stocks in the first place. If I buy something because it looks cheap, then it makes sense for me to sell when it's expensive. Because if I don't do it, I don't have a philosophy that is actually consistent.
Makes sense. Amazon.
Amazon is too rich for my taste, and here's why. I love Jeff Bezos. I love the vision he has for the company, but his vision is almost entirely driven by let me dominate the retail business in terms of revenues and worry about profits afterwards. By my estimation, Amazon's margins will have to hit about 8 to 9% for it to break even at today's market price. I just don't see that as feasible in this retail business with the kind of revenues that Amazon has. So from that margin perspective, I don't like Amazon. I think it's overpriced.
Twitter.
I think it could be a very valuable company, but not with its existing management. I think these guys really don't seem to have...
Just swallowed his tongue.
I think that these managers don't seem to have a plan to convert users to revenues. They seem to be hoping that something good will happen, but that's not a great way to run a company.
You're not worried about the flatlining in user growth?
I think even if it did, 300 million users is still a lot of users. If you can, I see Twitter feeds all over the place, right? I see them in news stories. I see them in links that people send me. So clearly, it's ubiquitous. A lot of people use Twitter, but they just it seems to be difficult for them to figure out a way to convert that, even the existing user base. Forget about the growth in users, the existing user base into revenues.
LinkedIn.
I like them. I like them as a company. I'm not sure I would add them to my portfolios, but it's one of those companies where I will buy at some point. It will be part of my portfolio sooner rather than later. So it's one of those companies where I put it on my watch list. I'm waiting for a surprise that pushes the price down 20, 25, 30%, and I'm going to be jumping in.
Nike.
Nike is one of those constants. It's been a company that's been in my portfolio for 15 years. It's one of those companies where it's never massively underpriced. It's never massively overvalued. It's a company that I'm okay with as a long-term investment. About half your portfolio has to be companies that you just buy and just keep as part of your regular investment portfolio. Nike has been part of that portfolio for a long time.
Tesla.
There are things I love about Tesla. I love the fact that it's disrupting a really bad business, the automobile business. So it's blessed with its competition. My one concern with Tesla is I don't know what kind of company it is anymore. When I first valued Tesla, I valued it as a premium automobile company. Today, I might have to value it as a battery company because the real technological advances that Tesla has made is not in the car side, it's in the battery side. So it could be worth a lot as a battery company, but I think I need to see some signs from Tesla as to what kind of company it thinks it is. Because it seems to go back and forth between being an auto company and a battery company. And until it makes up its mind, I can't really value the company properly. So at its existing price, I wouldn't buy Tesla. But as with LinkedIn, it's one of those companies that's on my watch list at the right price. I hope to have it in my portfolio.
Starbucks.
Starbucks, I've always been a little more pessimistic than most people are because I think that their real cost structure is hidden by the fact that they lease all their stores. And because of the way we do accounting, they always look more profitable and attractive than they are. If you capitalize the leases they have on their stores, it turns out that they're an okay business, but not an incredibly great business. So to me, it's not worth the downside to add a Starbucks to a portfolio. I think there are far better ways I can play in that particular field.
And last one, Alibaba.
Alibaba, I like it as a company, but I don't want, the way I describe it is Jack Ma wants my money, but he doesn't want my input. I don't want to pay 5-star hotel prices and be put in the outhouse, which is where I'm put if I invest in
Because
Alibaba.
of a two-class shareholder system.
It's a two-class, and it's also got this corporate governance system where the board of directors is appointed by these 19 secretive people who meet together in Hong Kong. I have no idea who runs the company, and I have absolutely no
FIFA-like,
control
right?
in how it's run.
Great. Thanks, Professor.
You're welcome.